If you can keep your head when all about you are losing theirs.
If you can trust yourself when others doubt.
What possibilities might you see?
If you can meet with triumph and disaster.
And treat those two imposters just the same.
If you can see it, the world is yours to trade. See it, IG it.
Hello, I'm Haslinda Amin. Thank you for joining us for the future of emerging markets. The IMF estimates emerging markets will grow almost 5% annually by 2023 versus developed markets at 1.4%, essentially suggesting that EMs will account for more than 80% of global growth. EMs also have companies that are going gangbusters. Think NEO, which has surged 1,000% year to date. Top Glove, up 400%. And of course, the usual suspects, BYD, Tencent, Meituan, Alibaba, all still trading at attractive valuations despite the recent rally given their growth potential. But as we know, there are risks to buying into EMs. Financial market volatility, political environment are among issues that can rock the EM world. So how do you navigate? Who do you buy? How do you hedge against the risks? Well, today you'll hear from EM gurus and our own market reporter who'll give insights into what she's hearing on the ground. But before we proceed, I'd like to thank our sponsor, IG, for making today's event possible. Please check out the resource center in the window in front of you to download more information on IG's market outlook. Also, some housekeeping to remind you of. Make sure you're using Chrome or Firefox to view this event, or you may just have issues logging in. If you are having issues, don't fret, don't worry. Issues with sound or playback, please just refresh your browser. That should do it. The size of every window you see in front of you is movable, resizable, so do as you wish. And you can also restore windows using the buttons at the bottom of your screen. And we would like for you to interact with us. Do send us your question. And of course, let's get social. Social media, that is, joining the conversation on social media with the hashtag #TheFutureOf, and you will be able to view a recording of this event on YouTube. So that's about it. Let's get started. Let's bring in our sponsor, IG, and Jingyi Pan for her opening remarks. Jingyi, please.
Good day. Thank you for joining us today and perhaps once again at this virtual event, this time themed Emerging Equities, sponsored by IG. Now, since our last installation of Bracing for the US Election virtual seminar, we've certainly seen an interesting twist of events with the political developments. President-elect Joe Biden had finally been confirmed as the next president of the United States for the next 4 years after a roller coaster of a ride for markets from election day. One area of the market that did not seem to flinch much through the episode had been emerging market assets, particularly in Asia. And when the odds had increasingly been pointed towards Democratic nominee Joe Biden's win, risk assets had only further soared. Now, with the latest developments on the vaccine front that had only further enthused emerging equities, we have seen the emerging index here on IG, which tracks the MSCI Emerging Market Index charging to the highest level unseen since 2018, following the news. This beckons the question as to whether the stars are only further aligned now for emerging markets. We'd like to look at this possibility from a couple of different lenses. These three are namely number 1, the US election outcome, 2, COVID-19, and 3, the broad technology adoption in driving growth for emerging markets and particularly Asia. Now, through the US election process, whether this was the initial blue wave expectation or later a Biden victory coupled with a split US Congress situation, EM assets had continued to be a beneficiary. The intuitive expectation is one of less confrontational trade policies under the Biden presidency, and as we have seen in Obama's care of the nation, even if it means we wouldn't see any backtracking of tariffs for the likes of China in the near to medium term, something perhaps very much needed as the global economy is still in the nascent stage of recovery. Now, the idea that have been prominent in supporting EM assets have been the safe haven perspective assigned to, well, particularly the Asia part of this group. Expectations for better recovery prospects, particularly Asia, had been the case, and even though markets may miss the quicker fiscal boost expected with a democratic sweep, the status quo without the materialization of any tax hikes under the split Congress had been perceived well. And over and above this, it is the fact that EM had remained largely a bright spot even as COVID-19 cases remain elevated in some parts such as India, which continue to keep this on our watch list. Not to forget, many parts of Asia had also seen improvements across production to mobility indicators, remaining resilient in the recovery and fundamentally being seen as a positive sign here. One part of the equation that had helped for emerging equities, particularly Asia, had also been the relative appeal here of the better management of the COVID-19 situation, or fears mount for the likes of Europe and US into the winter months. Any viable COVID-19 vaccine could level that. The latest news on the vaccine breakthroughs does suggest that we may have taken another step in the right direction. Although this would also, see to the acceleration of recovery, improve risk sentiment for emerging markets, and not to forget further mend the global market confidence that could further support export-dependent economies in this group. The road, meanwhile, to getting a safe and viable vaccine to mass market remains expectedly a long one. And on this end itself, monetary policy around the world is expected to continue staying accommodative, the likes of the Fed staying put with interest rates that could keep the US dollar subdued, and also many of these emerging market currencies in favor. We have been and is still looking closely to dollar offshore yuan for one, keeping to the downtrend channel it had been since mid-year. And finally, on the bigger picture, if there perhaps been any merits out of the COVID-19 episode so far, other than the environmental impact, it is perhaps the technology adoption acceleration. Besides the direct support this had been for tech export-dependent economies, mostly in Asia through the episode, the uneven recovery had also benefited many of the growth stocks in the region. Familiar names such as Alibaba, Tencent are just some of which we've noticed clients taking interest. Though concerns on valuations had been the case, these had also been the ones to deliver the returns, much like their US counterparts so far, and do suggest that they may continue to hold their own even as value stocks play catch up in this road to recovery. All in all, following the US election episode, emerging markets, emerging equities are perhaps only worth watching much closely now, and I dare say for Asia perhaps more so than others. And with that, on behalf of IG, we're glad that Bloomberg has curated only the best for you in this session as we look to the opportunities in the emerging space. Now, back to you, Haslinda.
Well, we definitely curated the best. Jingy Pan there. Setting the stage for us, let's bring in legendary investor Mark Mobius. He's co-founder of Mobius Capital Partners. Mark has spent 40 years investing in EMs. He joins us from Dubai. Mark, hello, and suffice to say, I am envious of your tan, Mark.
Thank you. The sun is very nice here.
Mark, first off, now the Fed says it will stay low for longer. The Fed says it will stay low for longer, even if it means high inflation. Add to that, we heard from Jingy optimism about a vaccine, never mind exactly when you and I will have access to it. Are we really looking at a global risk-on environment for the rest of the year and through 2021?
I think starting in 2021, we're going to see an incredible recovery globally. I think it's going to be a V-shaped recovery. And the reason why I say that is that we will have the end of lockdowns, not only because we have all the vaccines, not only because we have better treatment, but simply because people are not going to tolerate further lockdowns, and they will basically disobey any orders to lock down. And that will revive the economies very, very nicely. And you must remember, with a minus sign before the growth rates of companies around the world and countries around the world, next year with a plus, the percentages could be very, very big.
For the markets, though, Mark, the trajectory is not going to be straight up, right? I mean, we saw a correction recently, and some say it was a welcome correction. Do you see a deeper sell-off before the path goes up again?
See, the problem is that the market is a precursor to the growth in the GDP, the economic growth. So the market has already told us that next year we will have a very good economic environment. So we can't expect that too much from the market. Uh, Even with a very good economic environment, uh, we will probably have a good market, but not as good as we had this year.
Back in September, you said that you were sitting on about 10% of cash. Have you deployed that cash now or not?
Yes. Basically, any cash that we have is not planned. In other words, we don't plan to have cash. We want to be fully invested at all times. But in the case of that 10%, it was because money was coming in to our funds and we couldn't get it invested fast enough. Now we're down to, I think, about 5% and still reducing the cash levels.
Okay, so you talk about that V-shaped recovery and EMs playing catch up. This EMs playing catch up is not a new idea. We've been talking about it for the last 10 years. What makes it really convincing this time round?
What makes it convincing is the incredible strides that are being made in the two largest markets, China and India, particularly India. India is going like gangbusters. They're doing very, very well. And China, of course, continues to do very well. So those two markets are having a big impact on the rest of the emerging market scene. Now, of course, Latin America is not doing that great, but they're growing. They're beginning to grow again. And if you look at Asia, Korea, Taiwan, Philippines, Vietnam, all these countries are doing very well.
But having said that, it is not just developments in China and India. It's also to do with the vaccine and the Fed. What matters more to EMs? Is it vaccine? Is it the Fed?
I would say the vaccine at this stage, because psychologically it has an incredible impact on people globally because they see a light at the end of the tunnel, so to speak. Of course, the Fed, the low interest rate environment, is also very, very good, not only for emerging markets, but for markets around the world. But for emerging markets, it's particularly important because many of these markets have suffered from high interest rates. So with interest rates coming down, they are in very, very good shape to grow.
But having said that, Mark, I mean, we've seen what happened today. Markets back to being concerned about the virus resurgence in the US and Europe, despite those two vaccines, which are looking really promising right now. And there's a possibility that we may see that resurgence in EMs as well. How much of that has been priced into EMs right now?
Well, I think what's happened with the statistics, the statistics regarding recurrence or another wave, is really related to a greater degree of testing. In other words, with more and more testing, of course, you find more and more cases. The question you have to ask yourself is, okay, if someone is positive for corona, how many of these people get sick and how many people die? You'll find the percentages are very low. So I think there's a lot of fear when people hear about a second wave, but in reality, the impact is not that very great.
Let's talk about that optimism and the upside that is expected. I mean, if we do see that vaccine breakthrough and we do see that we're on the verge of getting our dose of that vaccine, what kind of run would we see in EMs?
I think a combination of vaccines and don't forget treatments. In other words, the scientists are finding new treatments for COVID, which are very effective. So the combination of these two things, plus, of course, a revival of economies, will be very good for the markets. And very important, continued low interest rates. The other factor you've got to consider is the incredible amount of money that's being put into emerging markets from the multilateral agencies like the World Bank and others. This is having another big impact in emerging markets.
Are you seeing a trend where money is being taken out of the US and being pumped into emerging markets in Asia in particular?
Well, what you're seeing is that people have made a lot of money in the U.S. They're beginning to get a little bit uneasy about the U.S. dollar, which is getting weaker vis-a-vis a number of the emerging market currencies. So they say, okay, I put $50 in the U.S. market. I've made another 50. Let me put maybe 20 of that into emerging markets to diversify my holdings and also get some growth. So confidence is returning to emerging markets, and that sort of is a self-serving circle, so to speak. It keeps on growing, and you're seeing more and more money going in as the markets revive. And that's a very, very important psychological phenomenon that you see in these markets.
You talked about being excited about India. In fact, India has the biggest weightage in your portfolio. How much of it has to do with India's economic recovery? How much has it got to do with the earnings upgrade that we saw recently?
It's a combination of things. Of course, earnings upgrades very important. Economic growth is very important. But probably most important for India is a reform program. Modi has instituted a number of reforms which are now having an impact on the economy and will continue to have an impact. And of course, these reforms have not stopped. He's continuing to implement them. You must remember in India, it takes time because you have the different states, a very varied population, different languages, different groups around the country, different states with very different characteristics. So it takes time for the reform to have an impact, but it is now having an impact and will continue to have an impact going forward.
Are you concerned that perhaps consumers have not been spending as expected? Shouldn't that be a concern to the market, which has been testing new highs after new highs? And in fact, the benchmarks in India today are at new records as well.
Well, you must remember that consumers in the shopping malls, in the high street shops, are not there, but they're on the internet. There's a tremendous amount of sales taking place on the internet. That's why you have a sort of bifurcated market with the internet-related stocks doing extremely well, and then some of the old line retailers not doing so well because they're not getting the foot traffic. So consumption is up on the internet, but down on the high street or the regular retail shops. But that's going to change as we go forward. You're going to see a return to the shops, a return to high street, a return to the malls globally, not only in emerging markets, but all over the world.
And you like technology stocks in India, Mark, but not internet per se, but the nuts and bolts of tech. What are we talking about? Cloud, 5G? What exactly is looking attractive with great potential?
All those, they're all attractive. What you're seeing now is an incredible demand for cloud. And for cloud, of course, you need thousands, if not millions of servers. And each server needs all kinds of chips, semiconductors. So it's not only in India. In India, we're more focused on the software side, but in Taiwan, Korea, China, we're looking at the nuts and bolts, the semiconductors, and the design people who do the designs for semiconductors. So that's the demand is incredible, and you see the demand for these semiconductors rising very rapidly because of the cloud, because of the demand from cloud services.
Does the tech rally make you nervous? I mean, can tech really continue its growth story? People are constantly now calling for the tech bubble to buzz. Hasn't happened yet, Mark. What's your take on that?
Well, there's definitely going to be bubbles bursting in the tech area. I don't know whether you read the new book called The $1 Billion Loser about WeWork. There's an example of $10 billion down the drain. So you're going to see these top tech bubbles, some of them bursting. But that doesn't mean the sector is going to burst. because the sector is growing in general. And of course, you see all of these unicorns coming in. Some of them will fail, some of them will succeed, but the sector in general will grow globally. And the spread of smartphones, 5G, all of these factors are having an incredible impact.
The tech rally in Asia mirrors what we've seen in the US, gains driven by a few large tech companies. Here in Asia, we're talking Alibaba, TSMC. Out of 1,400 companies listed on the EM index, the two accounted for about 40% of the gains last quarter. When will gains be more broad-based? What will it take? Which ones will play catch up? Which ones won't?
Well, you must remember, among the small and medium-sized companies, many of them have done much better than the leaders. You've had some, in terms of percentage increases, incredible performance in some of these companies. So, of course, with the index funds, with the exchange-traded funds, there is an emphasis on the big tech stocks, the ones that are big, have a big weighting in the index. But behind them, there are many small and medium-sized companies in the tech area that have done very, very well. In fact, have surpassed the performance of those big names.
So even if tech valuation looks stretched right now, they still hold long-term value. It's just a matter of getting the right tech stocks, right, Mark?
Well, that's right. And the key going forward now is going to be the prospects of growth, because that's what's really driving prices of these stocks. And people are beginning to look further afield, not next year, not the year after, but 3, 4, 5 years from now. What are the potential growth aspects for these companies? That's why return on equity is so important when looking at these companies, and the managements, the views of the managements in terms of their growth strategy is very, very important. So there are going to be a number of these companies that will do well over a 5-year period.
When you talk tech, I mean, you take a look at China, it's accounted for more than a third of the EM recovery since the March bottom. You talk Korea, Taiwan, they account for another third. Not surprising given that they are the tech story. So do you see these North Asian markets continue to lead?
Yeah, they will continue to do very well, but some of the other markets will come up from behind, particularly those markets that have been very unpopular for one reason or another. And you're going to see growth in a number of surprising places in emerging markets.
There's a question here on China from one of our participants, and the question is, how do you see stronger regulations on tech giants playing out in the markets? Of course, this is in the context of the clampdown on big tech, on fintech in particular, how China put a lid or put a stop to Ant Group's IPO.
Well, this is a global phenomenon, and not just in China. If you look at Europe, you'll see they've been cracking down on some of these big tech giants, particularly as regards to tax control and that sort of thing. And you see in the U.S. as well, there's concern about the growth of these big tech giants and the impact it's having on the mentality of people and society in general. So this trend, simply because of the size of these companies, a lot of antitrust laws will kick in and impact these companies. That doesn't mean they're going to stop growing, or that the sector is not going to stop growing. And this is true in China as well. Ant is not going to go away. They're still going to be making very, very good profits and growing. And it's true of all their competitors. I think in the case of the Ant IPO, there was quite a lot of concern about what the impact on retail investors would be with this company if it didn't do well, particularly if the government had to more heavily regulate the company. But there's no stop to their growth. That's no question about that. What we're going to see, however, is the traditional banking sector being changed. and a lot of the major banks will adopt all of the tech that you see with Ant and other companies like that.
It will not stop that growth, Mark, but could it limit that growth and hence change that growth landscape?
Of course, it will change the growth landscape and they will take different routes. I mean, the logical place for Ant to be would be in bed with one of the major banks or a few of the major banks, because that would give them legitimacy and would preempt any problem with legislation and regulation. And I believe that's the trend globally. More and more of these fintech companies realize they've got to tie in with the traditional banking sector, or otherwise they're going to get into trouble.
Mark, how about tensions between the US and China, which may taper, but some say it could also remain elevated under a Biden presidency? Biden has called Xi Jinping a thug, and I guess that's an indication of where he's headed in terms of his policy towards China. He's taken issues on everything, including China's stance on Hong Kong, on the Uyghurs, on Taiwan, as well as trade and technology. How do you see this playing out under a Biden administration?
Well, under Biden, I think the rhetoric will be much, much softer. It wouldn't be the kind of rhetoric that we had with Trump. And that means the pressure will be off China. You might say that China has won the election because it's the Biden presidency will be much, much better for China. You must remember, even under Trump, the Chinese trade surplus has not reduced. So they continue to do very well economically. And of course, they've been the first major country to be out of the COVID lockdown problem. And now we're seeing a very good economic revival in China. So the presidency definitely is good news for China, I would say.
That takes us to another question from our participants, asking you what will be the impact of a Biden presidency on emerging markets?
The Biden presidency will be good for emerging markets because the global stance of the Biden administration will be much open, much softer vis-a-vis what we saw with Trump. So he will probably be much more lenient on trade relations with emerging market countries. That probably is going to be positive for emerging markets generally.
That's on the basis that he eases on the tensions with China, but there are also a school of thought suggesting that he may continue adopt the same policies as President Trump.
He will adopt some of these because some of them are sort of set in stone, and that will continue. But the rhetoric, which is very important psychologically on the markets, the rhetoric will be toned down. In other words, the negotiations will be much easier, I believe, under Biden.
Mark, I want to talk on financials. Banks have lagged most sectors. Do fundamentals justify the underperformance? Do you see value in financials in emerging markets?
There is some value in the financial sector in emerging markets, but many of these financials are a black box. It's very, very difficult at this stage, given the COVID lockdowns, etc., to assess what is the bad loan situation in these banks. The banks are very good at glossing over these bad loans, and you can't get a straight answer very often as to the degree of defaults you're seeing down the road. So I'd be extremely cautious on the financial sector. There will be some winners, but you've got to watch it very, very carefully and try to assess the non-performing loan situation.
What would it take for you to reverse your call on banks?
Well, first it would be a very strong economic recovery, return to the retail sector, and then some more transparency from the banks as regards to the status of their bad loan book.
Speaking of banks, the central banks, they have promised support. The likes of BSP say they still have a lot of ammunition. Add to that, the state guarantee for loans, debt moratoriums are all getting extended. I mean, how long do you see central banks having to play this role of providing liquidity and guarantee?
Will continue up to the end of this year and the beginning, maybe the first 2 months of next year. Once the economic recovery becomes evident, then you'll see a toning down of this, and then the banks will begin to ask for their money back. But it will last for at least another half year.
Is there too much reliance on central banks, Mark?
There is lots of reliance on central banks, and that's been the case not only during this COVID crisis, but even before that. People think central banks can wave a magic wand and solve all economic problems, and of course, that's certainly not the case. In fact, you might say that too much reliance on central banks has been a problem. It's created more problems than it's solved. What is really required is companies to get back to full operation and an end of the lockdowns. Central banks can't control that. And the key, of course, is revival of the economy.
Isn't it true, though, that it's also the markets that's highly reliant on central banks?
Of course, everybody's watching very, very carefully what the central bank is of the central bank's actions.
Mark, we have a question here from another participant following up on the issue of China. Do you think Biden being more diplomatic and clubbing together with Western nations will be worse for China than it is for Trump?
No, I believe Biden will follow a policy of accommodation with China. I think that's the path he will take as regards to foreign relations. And of course, he will want to contrast that with what Trump has been doing.
I can't help but bring in Bitcoin as an asset class. I mean, surprise, surprise, one of the best performing assets so far year to date, just when you've kind of forgotten that Bitcoin even exists. You've been a non-believer in cryptocurrencies. Any reason for a rethink now?
Available to gamble. People are looking at Bitcoin and the other cyber currencies and treating it as sort of a casino, let's put it that way, because you really can't look at the fundamentals of you don't know how much is being produced. So it is a gamble, but it's fun for a lot of people and they like it.
Mark, before I wrap up, how would you invest $100,000 in current times?
I would put $100,000 in emerging markets if I had it. Of course,
break it down for us, Mark.
No, you must remember that for a normal portfolio, of course, you don't want to put everything into emerging markets. But if you gave me 100,000 now, I'd put it into anyway. I've got other money in other stocks around the world. And you must remember that the U.S. market is the largest and most liquid market in the world. And many of the companies listed in the U.S., they're global companies. So you do get exposure to emerging markets through them.
Mark, we have to leave it there. We've been having some technical glitches there, but we appreciate your time today. Thank you so much for your insights and joining us now. Let's get some insights from Bloomberg's coverage of emerging markets. I'd like to introduce to you my colleague, Jackie Edwards, who joins us from Sydney. As you can tell, we're going around the region. Jackie, looking at the themes in our emerging market coverage, markets so bullish, what's our reporting telling us whether or not this EM rally has legs?
Hi, Linda. Yeah, emerging equities have enjoyed a pretty healthy rally recently off the back of some positive news about a potential COVID-19 vaccine. And they've also seen a boost after Democrat Joe Biden's U.S. presidential election win. Now, those are only some of the most recent drivers for emerging stocks, but there are some other factors that could point to further gains. For example, quickening growth in developing nations, the profit upgrades that we're seeing across emerging markets, and just the unprecedented amount of stimulus being deployed by governments around the world during the coronavirus pandemic. That's helping to underpin investor optimism and drive emerging stocks higher. And one area in particular that I'd like to highlight where we're seeing this EM enthusiasm play out right now is in exchange traded funds. Mark mentioned just now that we're seeing more money going into EM markets at the moment, and quite a bit of it is coming through ETFs. If you look into inflows into US listed emerging market ETFs, those funds just posted their best 2-week inflow since January. And that's over the course of the 2 weeks that ended on Friday. The promising vaccine news coupled with Biden victory, that helped drive about $3.7 billion US dollars into those funds over that 2-week period. And again, that's the most since January. So that is definitely a sign that investors are feeling pretty positive about emerging equities at the moment. But even so, it's still important to note that surging virus infections in the U.S. And in some developing markets like India and elsewhere in the world, along with the potential for further lockdowns, that may leave investors feeling a bit jittery at the moment. Adding to that, we've had a lot of positive vaccine news lately, and much of that could already be priced in. So that could be affecting emerging markets in this rally that we've seen. But, Mark also just pointed out a bit ago, we're seeing fewer people get sick from the virus, and virus treatment has improved generally. So that's something else to consider when we look at this rally.
That's it, Jackie. I mean, vaccines is one of the themes that people are looking at in terms of the emerging markets play. I mean, how will the vaccine news really play out in the EM space? We had Bank of America saying, sell on the vaccine news. How susceptible will EMs be to this thinking?
Well, yeah, so over the last few weeks, we've seen positive vaccine developments from Pfizer and more recently Moderna. And that's been driving this global rotation from growth-oriented shares into parts of the stock market that have been really weighed down by social distancing and lockdowns, as well as stocks that are more economically sensitive. That's definitely been playing out in the EM markets. In Asia in particular, Thailand and Indonesia, those are two markets that are benefiting from this shift into value stocks amid bets of a global economic recovery. Both those markets have a really high proportion of value shares. But I also want to talk about what might happen once we get closer to having a successful vaccine. It's likely that we'll start seeing investors start to pick out what nations might be better prepared to distribute the vaccine quickly and efficiently versus those who may not be able to do so. Another factor that is likely to weigh on investors is, weighing up different government scope to take on more debt if they want to roll out the vaccines freely or at subsidized rates. So a greater number of their populations can be inoculated. Just if you look at forecasted debt to GDP levels for next year, those levels in Asian countries like China and Indonesia, those are projected to be lower than their peers in the developing world based on projections by Moody's. So, that could affect those countries and whether investors go into those markets once more vaccine developments come into light. But also, many countries have already shown that they have capacity to curb the spread of the virus. just in Asia and the EM markets, China, Taiwan, South Korea, they were among the first nations in the world to shake off some of these pandemic restrictions. So that's been a positive for those markets as the world waits for a coronavirus vaccine.
You touched on growth versus value, that rotation from growth to value. I mean, what's the thinking there? Will that continue? What will it take for that to continue?
It's hard to see. We've seen this kind of push-pull in the last couple of days, how investors' focus have really gone back to that growth part of the market, the tech shares, and then back to these value-oriented stocks like banks. We could see this push-pull kind of play out until vaccine developments become a little bit more clear and as economies start to recover more and more for the coronavirus pandemic.
You touched on India. I mean, is a market that Mark Mobius really likes, as we heard earlier. Is it really sustainable? I mean, we had the likes of Morgan Stanley, Goldman, JP Morgan all saying, yes, yes, yes. India is more sensitive to vaccine news than other Asian markets.
Oh, that's right. And, some of the stocks and sectors that analysts have pointed out that might benefit from a Joe Biden presidency, those also come from India. Some of the stocks and sectors that analysts say are most likely to benefit from a Biden presidency, those include, Indian software exporters and also some pharmaceutical stocks. So, pharmaceutical stocks in India and in China as well, they might benefit from a Biden White House when you consider that the Trump administration had previously outlined plans to produce more medications in the U.S. A lot of medications that are taken in the U.S. come from overseas, mostly from India and China. So, an election loss for Donald Trump, that may have removed some of the risk for pharmaceutical stocks in India, and they may have better prospects under a Biden administration.
The issue with India and vaccine is how well it can be distributed. There are questions when it comes to that issue.
And definitely, I mean, and that's an issue for everywhere, right? And we saw that kind of play out in the market globally last week when people were very excited about the Pfizer vaccine news, but then it started to set in for investors that there are a lot of roadblocks to getting a successful vaccine, for getting it approved, for getting it rolled out, even for storing a vaccine, because that particular vaccine had to be stored at very cold levels. So it has some transportation challenges, and those are all things that investors will have to consider going forward.
When it comes to the Indian market, Jackie, how are investors viewing the earnings potential? I mean, we had 70% of the companies and the Nifty 50 index beating or matching analyst estimates. Is that sustainable? Is that the feeling we have on the ground?
It's really difficult to say because we have had virus cases tick up there recently, so that does pose some risks. But overall, India stocks have had a really impressive rally. It's really hard to see where it goes to there from here.
Of course, Mark touched on this, the theme of the weaker US dollar. How will this play out? And how much conviction is there that we will see a weaker US dollar from here?
Yeah, I mean, the prospect for renewed weakness in the US dollar, that should give some investors a reason to invest into EM stocks, particularly in Asia. Market watchers like Mark have said that they are expecting continued weakness in the US dollar. That it could be good for EM stocks in particular. A weaker dollar often signals higher risk appetite, and that's seen as a positive for growth in Asia's emerging economies, which rely on imports that are priced in the greenback. And also when there's a softening dollar, U.S. investors tend to seek growth and earnings opportunities abroad in Asia in particular. And again, when you consider things like the implications of a widening U.S. deficit, possibly more stable U.S. foreign policy that could come from a Biden administration, and lower bond yields, all of that points to a softer U.S. dollar. And all of that could be positive for EM stocks and notably Asian assets.
When we talk EM, should we be looking at small caps in South Korea, for example, which may go gangbusters?
That's true. Yeah. I think that we should be looking at those. I think investors are chasing growth wherever they can find it. We're in a low growth world, and stocks are definitely attractive in this environment. And you kind of have to weigh your options. I know a lot of investors I talk to, don't usually invest in small caps, but they're starting to get into that space because it's an area of the market where they're finding some growth.
Jackie Edwards, my colleague in Sydney, thank you so much for your insights today. Now, just to recap, EM saw a 35% drawdown in Q1, then an 18% recovery in Q2, and as of now, EM stocks and currencies are at a 2-year high. Our next guest is super excited about EM prospects, in particular small caps, and Jackie has set the stage for us. Another veteran investor, Hugh Young, is Managing Director of Aberdeen Standard Investments Asia. Hugh's been investing in Asia for 30 years. He's still very young, by the way, and he joins us all the way, I think, from France. Hugh, I would trade places with you if you're somewhere in Provence. Are you?
Sadly not. More in the cold middle rather than the hot south. But soon to come back to Asia, thankfully.
Would love to have you back. Hey, Hugh, I mean, you've gone through several periods of market crisis before. If you look at the stock market downturn in 2002, 2009, we saw a strong EM rally 1 year after the US market bottom. Do you see that happening again? Is history a good guide?
I'm not sure it is a terribly good guide necessarily, but yes, I see in common with your previous commentators, plenty of scope for emerging markets to perform well. We'll see after a tough year this year for earnings broadly, we'll see a sharp earnings pickup next year. Still the underlying growth, as we see from all the forecasters for emerging market economies compared to developed market economies, is a lot higher. I mean, of course, risks are higher too, but you've got that tailwind of growth coming through. Ratings are still quite low in emerging markets. And very low in certain parts of emerging markets. So yes, I think we can have quite a nice run in emerging markets from here.
But it pays to be cautious, no? I mean, we have easy money, vaccine, prompting markets to look past 2020, and that's reviving risk sentiment, benefiting EMs, but like you said, that huge risk. I mean, huge debt, at Chinese SOEs, political tensions persisting in, I guess, Thailand, Turkey, Brazil, Peru, and who knows what's happening with US-China relations.
No, I agree with all that, and that's why you don't want all your eggs in one basket. So I mean, you've got to be very careful where you do invest, which countries you invest in, and of course, which companies you invest in. I mean, over the years of looking after emerging market funds, over 35 years now, the important thing really is to stick through cycles, become slightly counter-cyclical as well, and dare to go in when things look a bit bleak. And go into companies, and many of the companies we invest in today have been through some really tough times. So we've held a small bank in Indonesia from the mid-90s, and it survived the Asian crisis. It's survived various crises and has grown. So I think where you've got that good management and really absolutely vital is a strong balance sheet. That will see you through a lot of tough times.
So essentially, not all EMs are the same. There are those with high exposure to China, which is experiencing, some say, a V-shaped recovery, like Vietnam, like the Philippines. They may do better than their peers. Is that a fair assumption?
Yes, I'm not so sure Philippines is going to be a stand-up winner. I think we're going to see ultimately quite sharp rebounds from Thailand, Malaysia, Indonesia, India. A lot of that, of course, depends on COVID and vaccines and the like, and we'll see the same from tiny markets that have gone off people's radar screens, such as Sri Lanka, for example. Of course, all the emphasis in emerging markets has really been on the behemoths in China, largely the Alibaba's 10 cents, which is where most of the money has gone. And it's fled from ASEAN markets in general. So we have seen this two-tier market of tech versus the rest, and I think it's time for some of the rest to pick up. Of course, there's still some really great tech stocks. I mean, TSMC is still a really fabulous company. Samsung, great. The China internet company is great, but I think you'll see some pickup in the banks. So I'm a little more optimistic about some of the banks, but again, you've got to stick with the ones with the strong balance sheets and the conservative accounting policies, because as we all know, the issue will be bad debt, and it's still a tough environment for banks given low interest rates, and we don't expect interest rates to bump up anytime soon. So that will be sort of quite a headwind for banks. But with some of the valuations, we see some of the quality banks on, below book price and the like. It's not too bad. So we actually like things like the Singapore banks, for example. Not huge growth companies, but there's still room for growth. They're adopting IT very quickly. So I'm a real believer in integration. A lot of the old world is becoming new world. Much the same as we've seen acquisitions by the new world of the old world. So they're meeting somewhere in the middle. And certainly if you don't embrace technology in whatever business you're in, you're dead.
You brought up a lot of points, and I want to follow up on them. But first, why aren't you liking the Philippines? We had the finance minister just this week, in fact, just yesterday, suggesting that, recovery will pick up and will pick up quickly. We have the BSP saying that it has a lot of ammunition still and is willing to do whatever it takes. Why aren't you convinced that the Philippines could be one market that would benefit from China, and also that it will make a quick recovery?
Well, we quite like stocks in the Philippines. So we've got chunky holdings in Ayala Land. We own a big chunk of the port in the Philippines. So there are some good companies. It's quite a thin market, quite a narrow market. The obvious tech plays are not there. So it's far more traditional companies, and again, we think those have plenty of scope for a rebound, not just in the Philippines, but elsewhere within the region. So we're very happy sitting on things like Ayala and Asian Terminals, super companies.
And in terms of banks, you said you like Singapore banks. Emerging markets, though, emerging market banks, what are you liking, and what would you stay away from? I know you talk about how balance sheet is important to you. So guide us where you see the potential in investing in financials, in EMs here.
Well, again, places like India are at the quality end of the market. You've got some really strong financial institutions, the HDFCs of this world. The issue there is one of price, not of quality. As you were saying earlier, I think one worries a little about the Chinese banks given debt, although of course they have a very strong backup in the Chinese state. So I don't think they're going to be disasters, but one's a little less comfortable. And then it's just a matter of finding bank by bank the strongest banks. As I mentioned earlier, the one in Indonesia that we've held for well over 20 years, 25 years, has been OCBC NISP, which is a great little bank. So the devil's in the detail, and be wary of those big government-linked banks. because of course they're forced to do national service often, and that's a dangerous place to be.
You know, over the weekend, after years of negotiations, APEC nations signed the China-led trade pact, RCEP. This is supposed to be the world's largest trading arrangement, and it includes the likes of Indonesia, Thailand, Vietnam, lots of emerging markets. How much of a game changer is this for investors?
I'm not sure it's a game changer, particularly for investors, but I think it's a very strong and timely reminder of parts of the world investors have neglected for a long time. So primarily ASEAN, which has been very neglected compared to North Asia. Again, this has been quite understandable in the circumstances. The tech-heavy markets, the internet-heavy markets, or the hardware-heavy markets of the Samsungs and Taiwan Semiconductors. So it's a reminder that in fact, on our doorstep in ASEAN, there's a huge potential market. And of course, some of those markets have had trouble reaching their potential. Indonesia has been a potential for a long, long time. And yes, it's growing, but it hasn't been as smooth a path as some of the other emerging markets that we've seen over the years. But again, if those markets get their act together, which I think they are, there's great scope.
But Hugh, hasn't that always been the case? I mean, you take a look at emerging markets, you're constantly talking about the potential, but potential remains a potential until it is realized. And so far, these emerging markets have not realized their full potential after so many years. I mean, how do you get your head around that as an investor?
Mm-hmm. Oh, well, even not reaching your full potential, you can still make substantial rewards in the stock market, and even as an economy, not reaching your full potential. And India, in many ways, has been the classic that has always had the potential of a China, and I would argue China has by and large reached its full potential, year after year of 10% growth. India, in a sense, could do exactly the same, but it's always struggled, which has been largely, I would say, a political leadership issue in India, and you've seen that in other emerging markets, the Indonesias of this world as well. But even so, although they haven't reached their full potential, investing in the underlying stock markets and certain underlying stocks have been fabulous. I mean, we've held Unilever Indonesia for 25 years again. Fantastic. HDFC in India, the likes of these stocks have done really, really well. And I would say the certain equities will have been far better managed than the countries themselves. And that's ultimately what you're investing in.
Do you see EM assets breaking out in 2021 and beyond, especially with a weakening dollar?
I think the weaker dollar will certainly help sentiment for those markets and will attract more money into those markets. Simply coming out of the world's largest market being the US. So I think we'll see more appetite for US money investing overseas, particularly as we see the rhetoric on the political side easing. And I think that has been disturbing for many investors, and certainly encourage US investors to remain at home. And I think we'll see a higher appetite for US investors to internationalize their money. Will it all go into emerging markets? No, of course not. But some will. And as you said earlier, not all emerging markets are the same. Emerging markets can be very tricky. It's a bit of a false universe in a sense, putting all these markets together and assuming they're all the same. They're all very, very different.
And the thing about interest in emerging markets from overseas, from the US, for instance, is usually in China.
Yes, I mean, China's been the big one. I mean, it's a massive market. And we've seen the attention on the internet side, in particular there. But I think we'll see that sort of filter out to other markets. So there'll be a dribble down effect. But I still think the bulk of money will go into China. We're seeing big flows into our China A-share funds that we run, for example. So we've had billions come into those over the last year or more. So big flows coming into China, but not necessarily an easy market either. And we can see how the state can intervene. A lot is controlled by the state, and the state in China is all important.
When we talk about China, I have to bring in Alibaba and the other China big tech, which is in focus right now. We had this conversation with Mark earlier. I'd like your thoughts on it. I mean, we saw how China's big tech, from Alibaba to Tencent, losing almost $260 billion of market value over just 2 days on jitters over the fallout with the government. Do investors need to rethink how they view these companies and their growth potential? I mean, their global ambitions are being hindered pretty much by the government.
I think it's an important reminder to investors who controls things in China. I think as far as the Chinese state is concerned, the Alibabas of this world and the Ants are partners. I mean, they see them as partners. But of course, as if you like, junior partners, so they've got to play by the rules that the state sets. And I think the growth for both Alibaba and Ant still remains. But of course, they've got to play by the rules, and particularly with Ant in the financial space, issues such as capital adequacy are very important. Again, you don't want things to jeopardize the financial system, and arguably unfair competition against state-owned banks is not necessarily that healthy. So I think it's things are just being brought back into line, and I'm sure we'll see Ant float coming through again. But it's not a free ride. I mean, these companies don't have it all their own way, and they've got to, as any responsible company should in any market, act in the interests of society, and the party will decide what that is.
You say the anti-IPO will come to market soon enough. How long? Some say 2 months, some say 6 months. I'm going to pin you on that. Hugh, how soon do you think the anti-IPO will come through?
I'm a big person to pin. I would have thought logically now it should be in the new year. Now, whether that's before Chinese New Year or after Chinese New Year, I'm not sure.
There's a question here from a participant. The question is, Hugh, what is the most crucial criteria for an investment manager to consider a position in emerging markets?
I mean, I presume that's exposure to emerging markets within an overall portfolio, rather than an individual position in an emerging market portfolio. So when I look at that, really, it's a matter of looking at how markets are valued, growth prospects. For individual stocks, it's all to do with quality of management, quality of balance sheet, and of course the basic drivers of the business. But for us, balance sheets tend to be the financial figure that underpins all our holdings, because clearly we've seen many times where things have just fallen away in emerging markets for whatever reasons. So most recently, it's been COVID, Asian crisis, coups in countries, and if companies don't have strong balance sheets, they disappear, and we saw a lot disappear in the Asian crisis. So our financial metric that we start from is balance sheet, and then of course it's earnings growth, the type of business people are in, and of course the types of business we've invested in emerging markets has shifted hugely over 30 years. 30 years ago, we'd have quite happily just invested in the leading retailer on the basis that people in emerging markets get richer and start shopping in stores rather than off the street. And of course, that's changed with the advent of internet and challenges to the bricks and mortar retailers. So it's constantly developing.
Like Mark, you like India. You've always liked India. You've been overweight India for 30 years now. Is India entering a bull market with lower rates, flush liquidity? Can that support market valuations?
Market valuations are high. So ultimately, yes, liquidity, lower interest rates help markets, but really we've got to see that growth coming through. And India's disappointment, I think, has been in growth. So the underlying growth of earnings in India has been slow coming through, and it's been postponed for various reasons. Goods and services tax, the demonetization, issues like that in the past, and of course now COVID. Again, we see a sharp pickup once we get through the COVID crisis. But India was struggling on the earnings front, and the big issue in India, which is where you have to be careful, is in the banking sector, and the banking sector has been full of bad debt. And the government has been very slow to address that. I mean, it is addressing it, but slowly. And that has been a big sort of break on the potential of the Indian economy.
Are you buying into a potentially V-shaped recovery for India?
Yeah. Will it get back to the high of the V? Well, ultimately, yes, of course it will. Will it get back that quickly to the full level? I'm not sure it will. Is it going to be very sharp recovery? Yes, but not a full recovery that quickly. So it's going to take time. It's going to happen through next year, I think. And again, we come back to the banking sector, which I think is the most important issue for India to address the bad debt.
You're a long-term investor. I mean, from what we've heard, you hold the stocks for 20, 25, 30 years. Beyond 2021, what are the themes investors should be looking out for in India? What do you buy? What themes do you buy into?
Well, the same themes one buys into everywhere. Tech is an important theme, or although India's not renowned for the sort of nuts and bolts of tech, so the semiconductors and so on, you really look to the likes of Taiwan, China, North Asia for that. India's really good at the software side, so the traditional Indian winners. The emphasis is TCS, for example, in India. And then, of course, you've got the emerging internet-related stocks. in India, and then the consumers are very important. You've got strong consumer names, pharmaceutical names in India, banking names, which really companies which really possess some world-class managements. So there's a lot to go for in India, and new stocks coming to the market. So we have been shifting our portfolio. You shouldn't have the idea that it's been totally static over those years, but we've had a fair few companies that we have held for 20, 25 years, but we've added, the 10 cents and so on to our portfolios. Things in India, some digital marketing companies. I mean, there's a lot going on in these markets. And for us, it's always having the balance. And it looks as though short term, the balance might swing back to, this is right across markets, some of the more traditional areas of markets, which have been so neglected, and to some of the smaller markets. And of course, some of the smaller caps within the smaller markets are particularly attractive.
You talked about how your portfolio has not remained static. How have you reallocated? Give us a sense of the changes that you made.
Well, probably over the last 5 years, longer than 5 years, probably a big shift into, for want of a better word, new economy. Now, we've held the TSMCs and Samsungs for 25 years, and they continue to be large holdings within our portfolios. But we've seen a big shift into the more software related companies. I mean, in the early days, that probably started with the Indian, the Infosys and TCSs. And of course, over the last 5, even 10 years, that's expanded to the Chinese internet names and the like. So we've seen a lot more money go into typically North Asia. So our exposure to companies in mainland China, obviously in particular, as the markets opened, as we've got access to the market, as we've got to know the market better. Our Chinese weightings, I think, little over 10 years ago, would have had maybe 5% in China, in an Asian regional portfolio, and now it's sort of pushing 40% or so. So big shifts, and a lot of that is new economy based, not much in big Chinese banks or big Chinese industrials.
In the introduction, I said that you're really excited about small caps. Which small caps are looking good? You want names?
Well, a lot of small. We want well, a lot of the small caps look quite interesting to us, and it's a mix. It can be a mix of those that have been growing at a really great rate and have performed extremely well over the last few years. So one of our largest holdings is Momo in Taiwan. That's sort of an Amazon of Taiwan, to put it briefly, which has done very well and continues to show great growth. And then at the other end of the spectrum, you could say something like it's a John Keel's in Sri Lanka, which has been Sri Lanka's leading conglomerate, a small company in a variety of businesses, retail, property, hotels, which has been totally neglected. So you've got this quite, in a sense, a barbell in the portfolio. One stock that's performed fantastically well, that still has growth prospects, that we bought maybe 2-3 years ago on a mid-teens PE with a 4% yield, and that's shot the lights out. But still looks reasonable. At the other end, a neglected stock in a neglected market that's faced tough times with COVID. But looking ahead next year, hopefully you'll see a big rebound, and that really reflects sort of our small cap positioning. We've probably got about 40% in the exciting traditional growth areas of tech, IT, internet, and pharma, and then quite decent holdings in financials. When I mentioned the small Indonesian bank, we've got financials in Thailand and the like. We've got the port in the Philippines, property companies in the Philippines. It's a really nice spread of things.
Thank you for that. I mean, I really appreciate that. That you name names. You know, Hugh, when you take a look at the market right now, we talk about it being unprecedented. I mean, we've seen a surge in retail investors globally, with people stuck at home with little to do. They've taken up trading. Is this a good or bad thing for the market? Has the pandemic reshaped investor thinking?
Well, I'm never sure heavy retail is a good thing, because in some senses there's quite a bit of gambling involved in that, and it causes a bit more distortion. We've certainly seen that in some of the Korean small cap names, for example. So you will see some booms and busts as a consequence, but hey, that's what market's about. I mean, they do have booms and busts, and the likes of us have to look through those. We're not very clever at guessing when they'll actually peak or trough, but for us, it's looking at the businesses that will be the long-term winners, and that's what we continue to do. And of course, speculative activity causes prices to move in exaggerated fashion. And that's hopefully where we try and take advantage. So if everyone gets desperately depressed about banks, we'll sell all banks because we should be entirely in Alibaba. Then, of course, that gives people like us opportunity. But often we have to wait a long time. So we can be sitting on things for quite a few years and then have our return in a very short period.
Interesting, though, when we talk about retail investors, I mean, we ran a story how they've outperformed hedge funds on the whole just by buying oversold and riskier companies. I guess that sets up for some kind of complacency, and therein lies the risk too for the markets.
Yes, and markets have been quite momentum based recently. So if you have just been buying, again, I come back to the Alibaba 10 cents of this world, and those top names, wherever they happen to be, Amazon, etc. And it has been quite a one-way bet, and in many ways it's still hard to see, certainly from an underlying business fundamentals. You can still see the drivers behind it. The question then is over share prices and valuations, and there will be some classic disasters, as we've seen with the Wirecards and the WeWorks and so on.
Hugh, just one final question before we let you go. I asked Mark this question as well. How would you invest $100,000?
This is not for the general listener, because certainly the part of markets I find the most attractive at the moment are as we started the interview, mentioning the smaller caps. So smaller caps seem a great place to be. And over time, I think that's where you'll make your real return. So long term, the outlook's good for them, providing you do your homework, which is what the likes of us are here to do. And short term, I think, given the underperformance of small caps, again, good short-term prospects as well, I think.
Hugh Young, we thank you so much for being so candid and for spending time with us. And we await your arrival back to the Lion City. Thank you so much for that. Take care.